I think it's also critically important to point out that trajectory matters, velocity matters, both for revenue and profit in overall valuation multiples. And so if you're able to be at least in the top quartile, if not higher, maybe in the top, 5% industry peers as it relates to revenue growth and profitability, you're going to be in a position to command a premium for not only the multiple when it comes time to do a deal, but also for the number of buyers that would be interested. That tends to drive competition and tends to drive up, real offers in general. Hello and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World Headquarters in Bloomington, Minnesota. For those of you that tune in regularly and even those that don't, Revenue Rocket are the M&A people. We focus on IT services companies. With me today are my partners, Ryan Barnett and Matt Lockhart. Welcome, guys.
Good to be here, Mike. Well, we know what time of the year it is because football season has started. The trash talking has already begun. I mean, it's going. What's going on, Ryan?
Yes, well, dynasties are clashing out on the fields. We also have dynasties created every day in the world of IT services. And today we're looking at a subject of how to create your own a bit here. And it's an interesting topic we've seen a few times in the past and seen it a couple times even this week. And the idea is how can you create a larger company that utilizing the concept of EBITDA or arbitrage? And if you're new to merger and acquisition, this is going to be a topic that might be a little bit more advanced, but I think it's really fascinating. And Mike, I'd love for you to just get us started. How are deals typically looked at in the IT services space, and also what does EBITDA multiple arbitrage really mean? What's that mean in just plain English?
Yeah, sure thing, Ryan. So, deals in the IT services world, tech-enabled services world, are often built on a multiple of EBITDA, a multiple of trailing 12-month EBITDA, earnings before interest, taxes, depreciation, and amortization. And that number usually is lower for smaller firms and larger for bigger firms. And so there is a natural opportunity to aggregate firms that are smaller, ones that are healthy and growing and, trade at a specific multiple, into a larger firm that, as an aggregate firm or one that's larger, would command a higher EBITDA multiple. So, to give you a simple example, oftentimes IT services firms may acquire firms at, 5 or 6 times EBITDA for the smaller firms. And because they're larger, they may trade, upwards of 7, 8, 9, or 10, depending on their size. And so there's certainly a move afoot to buy a firm at fair market or aggregate many smaller firms at fair market, and then be in a position to have that contribute to overall enterprise value in a larger firm at a higher multiple.
All right. Thanks, Mike. I think there's a few things to unpack here. So what you mentioned is deals in our space are often traded on a multiple of EBITDA. What I heard you infer was that there's a few ways in which that EBITDA can be adjusted. So, for example, a deal in our typical space, let's say you are a managed service provider. If you're typically under a certain threshold of EBITDA today, let's say under $500,000 or even under $1 million in EBITDA, that's going to trade at a range that is typically lower than someone that's trading in a much solider position. So if someone is at 4 times EBITDA or 4 million in EBITDA you're going to be able to sell that company on an open market for a much higher level. Is that the simplest way to think about this? I'm buying low today, and size is a component that goes into the EBITDA multiple calculation. And because size is such an important factor, as we grow and become bigger, we can start to leverage that size to solicit larger offers from larger firms. Is that a good way to think about that?
Yeah, for sure. It's a buy low, sell high world, as you guys know. And so certainly, when you think about how a typical thesis of a sponsored company or private equity firm may be to buy a platform at a higher multiple, aggregate a bunch of smaller firms in there called tuck-in investments at lower multiples to further enhance that multiple before they might, exit that investment. And it certainly has worked for decades that way in various industries, including ours, and continues to do so with the prolific acquirers that are out there today.
Sure. Okay. So Matt, I guess I would love your perspective here, but what do you think the main drivers are in larger firms earning those larger multiples? Is it all about the scale that I had mentioned earlier? Or do you start to look at service lines and customer diversification? Do those start to play just as big of a role to start commanding those premiums?
Yeah, Ryan, I think that, obviously from a baseline perspective, size matters. There's just more stability, if you will, in size and scale. But then as you start to look at what creates size and scale and stability, you're really looking at the value that you can provide to your customers in the marketplace. By having greater numbers, you naturally have a more diverse set of capabilities, a wider set of capabilities, just because of the numbers of and capacity of your team, right? And that matters, right? Because more and more customers are looking for partners, for service partners that can do more for them. And by being bigger, you just have the ability to have more capability. And that capability is in the people, but also to your point, Ryan, it's in the service line, right? And, so I think that it really is about being able to demonstrate that you're moving up the value chain, not just in your size, but in your offerings, your capability. Also naturally, the larger a firm gets, quite honestly, the more money that they have to invest in continuing to grow their capabilities, in mature their processes, right? So they can be a best of breed provider. That doesn't always happen. At times, the arbitrage game can simply be just the growing in scale and size, but the very best firms use that opportunity that they have as they are growing, as they are acquiring different firms to really broaden out and increase their capability.
Right. And it seems like if you start combining a few companies that are like, and you're able to put these firms together, and sometimes it could be a group. I guess maybe a question later I'll ask later, but if you're able to put these firms together and build something better together, there's that uplift in that EBITDA just on how you're working and how the firm is growing. This concept sounds really exciting from both a buyer perspective and a seller perspective. If I'm buying a bunch of firms and I can start to see that there is a pretty decent exit that allows me to essentially buy low, but also sell at a multiple. It's not even just buying higher; it's selling. It's really selling at scaled multiples. And if I'm a seller and I sold my firm to a company that's doing this EBITDA multiple arbitrage, I'm starting to think, how can I, instead of getting 5x EBITDA for my firm today, or if I take 5x today, in the future, I've got a chance at something just much bigger. Mike, how does someone start to think about, should I start to consider doing this? Like, how exciting is that equity opportunity, perhaps compared to taking cash and walking away? I mean, how do you start to decide whether to take one of these paths?
Well, certainly, as a smaller firm who may be a tuck-in, as an example, you'll likely have an opportunity to what we call roll equity. If you've listened to any of our other podcasts, you'll understand that. Typically, these sponsored or private equity sponsors, want some portion of consideration that's paid for your firm to be in this quote-unquote equity role. And the way you can think about that is you're transferring a portion of your value or equity for the equity value in the sort of parent or the acquiring company. It's a great way for you to participate in this EBITDA arbitrage, because that portion of equity that you're rolling certainly will be valued at that enhanced multiple when that next recapitalization or change of control for the parent company happens. And so, there is no one size fits all here, but certainly it's not atypical for a buyer in the private equity world to, acquire 70% of a firm and ask that owners roll 30% equity into a larger company. That 30% equity, let's say you trade it at 6, maybe worth 9 or 10 now, because, you're now in a position that when that bigger company is sold with your company and as part of your company is part of that larger entity, it likely will trade at a much higher multiple. If the plan works and is executed well, and you're part of that overall delivery and execution team, if you want to call it that, regardless of the role you play in the ongoing entity, then that investment can grow not only with the additional acquisitions that would come after you and the organic growth of the all-up business, but also just based on leveraging this EBITDA arbitrage.
Sure. So if you start to think about this as a seller, you've got some great opportunities on a new place in the organization, continuing, we'd call that selling in, your influence on the company. The opportunity for that second bite at the apple, which could be really substantial. We've seen the second bite of the apple be bigger than the all cash up front in several of the deals that we've seen. Matt, I'd love to understand kind of what's the converse of this. What risks should sellers be aware of when rolling equity in a platform? Are there things like dilution or loss of control or capital calls that you start to think about that could make that gives sellers a little bit of pause before considering going all in a platform like this?
Yeah, great question, Ryan. I think as for those who've listened to the Shoot the Moon podcast know, 3 things need to come together in any opportunity: cultural fit, strategic fit, and financial fit. In talking about EBITDA arbitrage, we naturally talk a little bit more about the financial fit. However, it is just absolutely critical that you are joining with a platform, if you're a seller and you're looking at an EBITDA arbitrage opportunity that makes sense strategically, that you can see the pieces coming together, that you see the leadership and the vision from the leadership to be able to integrate firms well, to have everybody rowing the boat in the same direction. Because, we've seen scenarios where people are trying to roll up towards this EBITDA arbitrage opportunity, yet not do it so well. and the firm is actually goes backwards in terms of their organic growth. And that's not a good thing, right? That's not a good investment. You're looking at this as an investment. And so you need to look at it from that standpoint. Multiples are not guaranteed, right? There are ebbs and flows in the market, and, cycles matter. How you are classified, the equity that you roll, and how that equity is classified is absolutely critical. Are you pari passu, right, is the term in the industry, with the original owners or with the private equity group in the business? As additional equity is delivered to future buyers, what does that mean for your equity? Is your equity diluted in that scenario? All of these things need to be understood. That's why you work with an M&A advisor like Revenue Rocket, because we've seen it all and have a great deal of experience in these types of opportunities. But yes, as with anything, there are risks. There's operational risk. And, one of the things I didn't touch on was culture, and that's important. Again, we've seen sort of both sides to the story here, where a founder recognized that they were at a point where it was going to be difficult to scale their business. They saw an opportunity to join with a group and roll equity and find that 2 bites in the apple. And they had the opportunity to participate through their own leadership and their own experience to assist and to continue to develop that firm. And that's what, we look to put together. We have seen other scenarios where it was just a cultural mismatch, and the seller came in full of piss and vinegar and ready to go, but the opportunity did not transpire. And, they retained their investment, but they didn't get to participate. And that's really what they were looking to do. So you really do need to look at the opportunity as an investment, as a financial investment, but also as a personal and professional investment, and make sure that all of those fits come together.
Right, man. I think you just kind of nailed something we need to dig into is that, what does a company really need to do well in order to pull this off? And so what should a buyer realistically expect from an arbitrage scenario in the IT services world? Like, is this automatic? What you just mentioned, there's a lot of work that needs to get done. And so it feels like you need things like integration and growth to really make it work. Mike, I'd love to get your perspective on this. Like, let's talk about integration a bit. If the whole arbitrage plays really depends on creating a bigger, more valuable partner or a company, pardon me, what does the integration have to look like in those firms for that value to really materialize?
Well, I think as we talk about integration in particular, there's opportunities to enhance all up EBITDA. You're going to remove redundant functions in the business, or right-size them, or be able to leverage them in ways where, 1 + 1 really does equal 3. And I think just the logical nature of adding more EBITDA, which, is a proxy for the general size of the business and impacts multiple, like we've talked before, is accretive. So being able to effectively do integration in a way that does really, we use this term loosely, it does create a 1 + 1 = 3 or 4 or 5. Being able to not only save money on integration, but also create new opportunities together that you couldn't create apart for the, if you will, the now combined business, all drive towards that larger EBITDA pie, if you will. That larger EBITDA pie, as it continues to grow, post-transaction now organically, and probably continues to grow through other acquisitions, delivers on that promise of being able to trade again later at a much higher multiple. I think it's also critically important to point out that trajectory matters, velocity matters, both for revenue and profit in overall valuation multiples. And so if you're able to be at least in the top quartile, if not higher, maybe in the top, 5% industry peers as it relates to revenue growth and profitability, you're going to be in a position to command a premium for not only the multiple when it comes time to do a deal, but also for the number of buyers that would be interested. That tends to drive competition and tends to drive up, real offers in general. And so, all that's really important stuff vis-a-vis integration and ultimately getting to a higher end game number in the arbitrage game.
And I hear what you're saying, Mike. And when you think about these firms overall, I guess one of the questions when you're talking that came to my mind was, is there a size cap of what it takes to make this arbitrage to continue to work? Like the examples we've thrown out have been a firm that maybe starts at 5x EBITDA, so a firm that may be less than $1 million in EBITDA. But ultimately, is there a cap of how large this goes? It seems like we've already seen companies in the MSP space take advantage of this through some of the acquisitions that are there. Is there a point where is there always going to be a larger fish that can make this play happen? Either Mike, Matt, feel free to answer that question.
Well, I think the answer is probably yes, within reason. And what I mean by that is in a consolidating market, which we see in IT services, in all areas of IT services, where there's great demand for sticky, recurring revenue models, ones that deliver high value, whether we call it repeat or recurring revenue models, but and are really the final mile, if you think, for many types of technology firms in IT services. There's an insatiable demand from end user customers for that service. And so that will tend to create a lot of interest from capital markets, and it will tend to also create bigger and bigger opportunities for consolidators that are building larger and larger firms. I think to a point where, what happens with these large firms when it comes time for them to take advantage of their EBITDA arbitrage? It probably means that they may go public. They may be acquired by a public company. They may be acquired by a very large private equity firm that tends to do, transactions into the double-digit billions if they're large enough. But I think, to get to the base question, the EBITDA arbitrage game continues to play along there. Now, the biggest gains in EBITDA arbitrage, however, are with smaller firms, probably in the million to, $15, $20 million in EBITDA range. That range, you're going to see much bigger gains in the arbitrage between kind of 1 and 10 million. And, above 10 million, you'll certainly see them continue, but they start to flatten out because there's just a logical sort of cap on where a buyer, regardless of who they are and regardless of their capacity, can get a reasonable return, right? You can't, for the rest of your life, can't, continue to double down on, the multiple can't go from 5 to 10 to 20 to 30 to 40, because there's a point at which those buyers just can't get a return on some crazy multiple. And there's proxies for that in the public markets. Like if you see public markets, where do certain firms trade? Some of them trade kind of in the 20 to 30 in the tech space. 20 to 30 times EBITDA multiple. That's probably the theoretical limit, right, of where you would become a super large firm, getting to a multiple that, that's probably the top end. So that's just sort of another data point. So, where this arbitrage game works best is probably in the single digit EBITDA multiples and the low double digit EBITDA multiples.
Yeah, thanks, Mike. Those are a lot of the questions that I had here today. I guess part of this is that if you're considering being part of a organization that does this, what kind of questions do you need to ask the firms that you're looking to partner with in this? And again, the other question I guess that's on my mind is, can a strategic company pull this off, or do you almost always have to have a backing of a financial sponsor or a private equity type firm to make this happen?
Ryan, you're going right where I was thinking. No, yes. Yes, yes, a strategic opportunity can result in the arbitrage game as well. As a matter of fact, we've had multiple clients where we've assisted them, and they created their own funding ability through bank funding, through SBA funding, through their cash reserves in their own business. And, oftentimes what you'll see there is it may be a little bit longer road to travel in that scenario, but the premise is still the same. If you find very good fits, cultural fits, strategic fits, and very good talent that you can bring on board to be part of your organization, you can find this EBITDA arbitrage opportunity. Now, oftentimes what we see most of is that there is some investor backing. Private equity backing is most common. But that the very best firms have sort of the nature of a strategic buy that is backed by good capital reserves. And so both of those scenarios are possible. And to sort of kind of lean into the start of your question, as a seller, I think that you really do need to first look at the strategic fit and then the people that you are going to be partnering with and working with, both the operators as well as the finance partners, and really do a double check there. Does it fit the bill from a strategic perspective, and does it feel right from a people perspective? And if both of those are you check the box on both of those, then it's worth looking at, and it's really worth getting into dialogue about their plans, where they are at, towards the finish line of their goals. How long does it take? Do they intend to take? What is their capital reserves? And then, obviously it gets into all of the specifics related to the deal making. And so, these are very good opportunities. Often say to our clients, it's never a bad idea to explore opportunities with smart money.
Yeah, I think it's really well said. Mike, that's all the questions I had today. Matt, Mike, I'll turn it back to you for any closing thoughts or questions.
Great topic, Ryan. Really glad that we were able to cover it. As we always say, whether it's us or anybody else, get with an advisor early as you are considering a new chapter for yourself and your company. Mike?
Yeah. With that, I guess we'll tie a ribbon on it for this week's Shoot the Moon podcast. I encourage you to tune in next time. We'll unpack further topics of M&A and growth for your IT services companies. You need to learn more about M&A. Feel free to visit us on our website at revenuerocket.com. If you have any questions you'd like us to address on this podcast, shoot us a note at info@revenuerocket.com, and we will bring it up. Take care and make it a great week.